Hi guys, today I'll be doing a presentation about the accounting principle of accounting for uncollectible receivables. We'll be looking over an overview, different methods, and how it works in the end. So let's get into it. So firstly, an overview. The term uncollectible receivables is used to describe the portion of credit sales and accounts receivable the company does not expect to collect from a customer. Uncollectible accounts is used in the valuation of accounts receivable, which appears in a company's balance sheet. So that's what we'll be looking at today, and then now we'll go over some methods of assessing the risk and balancing. So here are our methods. The first method is the direct write-off method. Under this allowance method, if a specific customer's accounts receivable is identified as uncollectible, it is written off by removing the amounts from accounts receivable. The entry is a write-off to bad accounts that only appears in the balance sheet. It's a debit to allowance for doubtful accounts and a credit to accounts receivable. No expense or loss is reported on the income statement because this write-off is covered under the early adjustment entries. So here's our second method. This method is the percentage of credit sales or accounts receivable. This method allows the business to identify their allowance of bad debts at an earlier stage than normal, meaning that they have some heads up and expectation coming into the financial year. So what happens here is an estimate is given based on the previous experiences, with this percentage multiplied against credit sales or accounts receivable to find the allowance amount and then be able to be written off at the end of the year. This means that at the end of the year, or the end of the term, that if this amount is not equal to this account, that it can adjust it, but it normally gives a good estimate as to how much accounts receivable debt is going to be had. Arguably, accounts receivable percentage is better, as it is based on credit sales solely and not on direct sales. Aging debts is the third method of how we estimate debts which are going to have to be written off. Aging debts are debts the company has found that have had longer than expected, and it's a method used in order to find the debts most likely to not be paid off and accounted for. This is based upon accounts receivable turnover ratio and comparing that with the debts that they have in their inventory. This means that the debts that have been existing for way longer than they should have get written off and not kept in the balance sheet. Finally, in conclusion, it's a good idea to have these methods up a company's idea, but the ideal situation is all debts are collected. Although this is an ideal situation, it's not often the reality and needs to be taken into account.